Hey, everybody. Hope everybody's doing good. And I don't have my right camera on. Let me figure out what's going on here. I should normally have my slides. I have a glitch. Hold on a second. This has never happened before. And I got a big echo too. Well, I'm not going to do this. Somehow one of my cameras is not working. But more live TV jingles. Well, let's see what's going on. There's my screen. Use system audio. Install leader. There we are. Boom. We're back in business. Somehow the system forgot about the camera. And on the weekends, I'm alone. So thank you all for being here. Thank you to T&D Tesla for keeping us all safe. So let's jump in. This is a video I debated doing. I had a sleepless night, and the motivation for this came from a sleepless night. So let's just jump in. I'm a little bit worried about a couple of things, and let me explain why. Well, first of all, this is edutainment, you know that. And the concern I have for the story today is it's a story of governments, regulation, deficits, quantitative easing, taxes, and more. And everything will lead to a conclusion in the end of why it's important. But it's a different angle today. It's an interesting one because I always say, follow the money. But this time it's kind of in reverse. It's like, where is the money going to come from? And that is my concern because things are breaking down all over the place. And let me explain. So, and also the data I'm going to use today is very US centric, but believe me, it's worse. Japan, parts of Europe, etc., way worse. So you can use the data I use as an analog, and please do your own research at home if you live in Australia or Japan or wherever. But let's jump in. So first of all, I did tweet something yesterday, 24 hours ago, and this kind of triggered a lot of my thoughts. And of course, it was basically, it was a weird alert that popped up on my trading view. I wanted to know exactly at what price the S&P 500 would be when it's divided by the empty money supply and the return is zero from the inception, which was about 63 years ago, 64.25 years ago to be precise. And when you look at this, when you look at the money supply growth, I've proven before a few times that when you increase the money supply, you debase purchasing power by the exact same amount. So for example, you pump 40% new money supply into the system, real estate goes up by 40%. So does everything else. And that's just how it works. Now, the real issue here is if the money supply in an economy increases faster than the growth in the supply of goods and services, for example, the stock market is a key function of this, prices will rise and each unit of currency will be worth less. Remember that. And this means that people will have to spend more money to purchase the same goods and services, which is a loss of purchasing power. And the channel is all about at least helping people find a way as much as I possibly can. And I'm not always perfect, but I've been lucky in my life. So let's go to the first exhibit today. This is the US budget 2022, just came out. And this got my attention yesterday. The federal government collected $5 trillion in revenue in fiscal year 2022. That is the US government. And that's about $15,000 per person. Pretty much on the nose. But they spent $6.5 trillion, which is $20,000 per person, including funds distributed to states. So what the heck is going on here? You know, they're pulling in 15, spending 20. Sounds like, oh, it's not too much. But when you multiply it by 340 million people, it's a lot of money. So let's break into the actual federal budget. And this, I kind of knew, but I was still shocked about how much comes from a certain area. And this is kind of what had me so concerned, is if you look at the revenue side of this, say, profit and loss account, you have individual income tax, 2.63 trillion, payroll tax, 1.5 trillion. Those two alone make up a huge lion's share of the total. Then you've got the payroll tax comes from different areas. We don't have to be concerned with that, but a lot of it is Social Security. Then corporate tax is tiny, $400 billion. Businesses do not pay taxes. All the taxes come from individuals. And then customs duties, small peanuts, etc., sales and excise. And then you look on the right-hand side, you got Social Security, which is increasing, National Defense, which should increase considering the state of the world today, Medicare, it's $0.756 trillion. Assistance to individuals is growing, $619 billion. Interest on debt, $485 billion. That's going to double in 2023. No ifs, ands, or buts. That's going to go to $1 trillion. And then transfers to states and other spending. So what? It is really concerning when you look at this. If this was my personal P&L account, I'd be freaking out. So let's look at the breakdown and put things in perspective. This is the stunning statistic that in the US, individual income tax brings in 52.3% of US revenue for the government. Payroll tax, 30%, 29.9 exactly. Those two make up 83%. And the rest is buttons, 8% corporate tax, customs duties 2%, state and excise tax 1.7%, other 5.7%. It all comes from jobs, and that is the issue. This is the 83% of government revenue that is tied to payroll. What happens? What happens if something happens to those jobs? That is my concern. Let's look at the spending side. You can see it's kind of equal. 18% on Social Security, 16% on defense, 12% Medicare, 10% to individuals. Interest and debt, 7.5%, which will go to 15%, by the way. Transfers to states and other spending. And I'll break all these down later. But the point is, many of them are growing on the expense side. And the income side, if it's doing anything, it's going to shrink. Again, my concern. Let's look at exactly what's happening. And I did talk about the fact that deficits would explode in 2023 many, many times. Because when we go back actually to the income part, this is the piece I want you to draw your attention to, the individual income tax, 52.3%. I was not able, and I've been looking for years to find out the breakdown of how much of this is tied to capital gains. But because we had the worst bond and stock market year and crypto year in the history of the world, capital gains will be zero. So people will not be funding the government with the typical income that they're expecting. And because of that and many other factors, this is from Bloomberg just the other day, there has been a $459 billion deficit over the last 16 weeks. That is stunning. People still have a tough time wrapping their heads around billions and trillions, and I'll help you do that in a second. But this is $459 billion in deficit in just 16 weeks, which started October 1st. And that's a $200 billion increase over the same period a year earlier. And that's going to get a lot higher because they haven't even begun to roll short-term debt into the new higher rates, Fed funds rates, which is going to just explode deficits altogether. So let's look at the debt ceiling talk, which again, everybody's been worried about for the last couple of weeks. Debt ceiling, $31.4 trillion and subject to the debt limit. But we don't have to worry about that because we blasted through it. U.S. national debt is now $31.55 trillion. So it's just moving so fast. Every time you go back to this U.S. debt clock, it just keeps going up, and the other numbers keep staying stagnant or going down. It is stunning, absolutely stunning to live through what we're living through right now. All right, so I put together a reviewed budget of where I think, and trust me, this is all coming together to make a point at the end of this story. This is what I think will happen to the US budget deficit in 2023. The individual income taxes will drop quite dramatically. Payroll taxes will also drop because there's huge layoffs, although the Fed thinks the employment market is strong. But, when they correct their numbers 6 to 9 months later, they're not at all. And mark my words, I will be right. I was right last year about this, and I'll be right this year too. Social Security is going to go up. They've increased Social Security by a big chunk, and there's more people rolling into retirement. Medicare is going to go up because medical expenses are more expensive. And of course, interest on debt is going to double. So the spending side is going to go up dramatically, and the income side is going to fall. And that brings us to my Invest Answers projection of the Fed budget 2023. I will come back to this in Feb 2024 and see how close I was. So my estimates, I know you touched 3 of the numbers too. Individual income tax will fall to about 1.9 trillion from the 2.4 approximately. Social Security will go up to 1.4 trillion, and the interest on debt will go to $970 billion. That will give us a new deficit of 2.89 trillion, which is up 98.28% from the 2022 numbers. Again, these are startling increases. To put things in perspective of what a trillion looks like, this is $1 billion on the left. That's a 6-foot-tall man, and they are stacks, 8 of them, of $100 bills. That's $1 billion right there. You would need many, many forklift trucks to lift that. Now, a trillion is the number on the right, and we are going to be down exactly, the deficit will be 3 of those big things on the right. Again, an unconscionable number to even imagine, to even think about how you can get this back from tax revenue. And that is the point, and that's my concern. I know where the money's going to go, but how are they going to fund this? And the only answer I have is deficit's going to explode. But before we get there, there's another thing happening that is also very concerning. So what if AI impacts the job market? Well, it already is. A lot of people say ChatGPT, this, that, and the other, but it's really already impacting people who write for a living, people who are journalists, etc. It is hurting them because it's enabling far fewer people to do a lot more by being supported by these AI tools. Forget bots working in factories and everything else. That is the real concern. So to summarize what I see as the structural change in the job market, and there's a couple of tips here, by the way. If anybody is young or in college and where they need to position themselves, check this out. This is important. Or if you have kids who are thinking about a career, first of all, automation and digitization is replacing jobs fast. If you are in Japan at an airport, 10 years ago, I was getting a beer from a robot. Today in San Francisco, I can get a coffee from an automated robot as well. Grocery store, you check yourself out. Amazon store in San Francisco, you walk in, you walk out, you don't do anything. It knows what you picked up, and it knows who you are from your Amazon card, just charges you directly. That's already here, and it's only ramping up. Then you have shifting industries. I do believe there'll be a growth in healthcare and technology sectors. The renewable energy sector will be red hot, green infrastructure will be red hot, and sustainable agriculture. So think about these as future career moves as well. But all other industries I see as potential going into decline. Then remote work, although we think deglobalization is happening, roles still happen offshore. I work with a large number of people offshore. And not necessarily because I'm trying to save money, but I sometimes find the best talent in places like the Netherlands or Sydney, Australia, or Colombia, etc. Then you have the gig economy. There are fewer full-time jobs. This is already happening. And people have 2 or 3 jobs. I think nearly 10 million people have 2 or 3 jobs right now, and that's all part of the whole gig world. And then you got AI and bots, and they will replace many existing jobs. So this is going to have a huge impact on, remember that 83% number? Very big. So coming to that conclusion, this is the 83% number. I do believe the US government needs to figure out, and all governments around the world, if they can no longer tax the citizens to death, where will they get the money? Because this 83% is going to go down fast. No ifs, ands, or buts. In addition, some of the gremlins I'm hearing, the rumblings over the last couple of days from talking to people and listening to people, you have blue states, which are the democratic states in the US. They're making moves to fill their coffers, i.e. tax people. And they're going after the multimillionaires and billionaires first. And they're trying to block the escape routes because they've noticed. I've been talking about this for ages too. I said, look at places like California and others, Illinois, New York. Everybody's gone already. Now the clever politicians in these states are like, oh God, we got to close the doors, block the exits, keep them in, lock them in, because we're not getting our tax revenue from them anymore. And they pay the lion's share. The millionaires and billionaires in California, for example, pay 40%, more than 40%, maybe nearly 50% of all taxes in the state. Now, the logic behind what they're trying to do is, this progressive tax reform, they call it. They wanted to really go after the really high net worth people, the 8-digit people, as I call them, people with over $10 million or more. It's happening in states like California, New York, Illinois, Maryland, Hawaii, Minnesota, Connecticut, and Washington. They've all come together to block the exits, and many places already have bills. In fact, San Francisco is trying to create their own little wealth tax as well as California. go after these people, but these people are smart. If they haven't left already, they're making plans as we speak. This is part of how these people are realizing, Houston, we have a huge deficit in our state right now. What are we going to do? So let's talk about deficits. I did model out based on an old Wharton data with updated data as to where two things are going that are very important to look for. This is the next 80 years. This is the deficit over GDP and public debt divided by GDP. The deficit over GDP is on the left, going up to 50% in the year 2100. And on the right in orange is the public debt divided by GDP. And that will be going up north of 1,000%, believe it or not. So the only takeaway you have to take from this chart is deficits are exploding. Okay? How will governments pay for this? There's no getting back to a 66%, 70% debt to GDP ratio. It's gone. It's just going to increase. And that means money printing is going to increase too. It has to service the debt. The US government can't go bankrupt, but they can print to infinity. And that's what's going to happen. So here's a quick summary before I get to the main conclusion. First of all, the government thinks everything is fine, but states are beginning to get hurt. And the real view is the job market is changing. There will be fewer good paying jobs. It will reduce the amount of government revenue. They're just waking up to that right now, which will in turn explode deficits, which will require money printing, QE to infinity as I call it. And then money printing will drive purchasing power debasement, aka inflation. What you have in your pocket will buy less eggs, less apples, less spinach as you go forward. And the government will be enforced to enforce new taxes to help reduce deficits. But they're just going to squeeze everybody to death. And those with the money will do a Raoul Pal and go to the Little Cayman or go to offshore jurisdictions or head to El Salvador or who knows where they'll go just to protect what they have. And that's the problem. That's not the solution, which the governments think. In addition, maybe, but maybe not. It could be a little bit too much tinfoil hat going on here. But, the choke point fear that rattled the crypto market since Wednesday last week from Nick Carter. He didn't want to alarm people. We discussed this about how the government is planning to take crypto down because it's a threat to the existing system. It also is a threat to the control of the people. But according to Jake Chervinsky, this is accurate. Without new legislation from Congress, federal agencies lack the authority to comprehensively regulate crypto markets. So their fallback position is to weaponize control over the banking system to mandate discrimination against crypto companies. This must stop. But also, the weaponization of the banking system is exactly what the Great Reset is all about too. You have nothing and you will be happy. You will own nothing and you will be happy. And that is the scary thing. So, the final conclusion. I'll let you get back to your Saturdays, everybody. And of course, Sunday if you're in Australia. Enter Bitcoin. No central authority controls Bitcoin. There's no need for banks when using Bitcoin. The most secure computer network on earth is the Bitcoin network, which means don't worry. As long as you don't lose your keys, you're going to be fine. Bitcoin is borderless, which means you can take it anywhere. You can send it anywhere. It is the hardest asset on earth. 72% are long-term holders. And it is confiscation resistant. So it is the perfect tool to survive the Great Reset. And I know firsthand there are billionaires in San Francisco looking at this right now and looking at their escape routes because they are being threatened and scared off by the governments in place. And per my video yesterday, I'll add here with our friend Jamie Coots from Bloomberg, it was incredible. He believes, and it took me by surprise because I'm the bullish hopium guy. He said he believes a supply crunch could come as early as late this year. And we all know what that means for price. Anybody who knows economics. So with that, everybody, thank you all for spending a few minutes with me on Saturday. Hope you enjoyed the KPM. Sorry for the grief tidings. I didn't sleep last night either. So thank you all for being here, and I'll see you all soon. Bye.